We're gonna, so the end of last class, I gave you some homework. I'm gonna share my screen with you, so we're gonna read the problem again. Uh, so, um, Bumblebee lives alone in San Antonio. So what is his filing status?
He's filing single.
Right, yes. No, he's never been married. He's employed full-time as a store clerk at the Honey Shop. He's a U.S. citizen and lived in the U.S. for the entire year. He is not the qualifying child or dependent of anyone else. So whenever you have a client, we need, again, proof of who they are, and that's with his driver's license. And these are questions you'll get used to asking, and there's actually a template of questions to ask new clients. We also have on our software, if clients like the internet and they want to do stuff online, they can answer these questions themselves. And we always need, photo ID of all our clients. So this example gives us his driver's license number and when it expires. Oftentimes we're letting our clients know that their license are expired. They don't realize it. So during 2024, Bumble was employed full-time at the Honey Shop. He received one W-2 from his employer. He also received interest and dividend statements that are attached. He has no interest or authority over any foreign accounts. You'll have to ask every client, do you have a foreign account? And do you have any crypto, virtual currency? The IRS now wants to track that. If anyone does have any type of virtual currency, you still have to claim if you receive any interest dividends or you buy and sell it if there's any capital gains. So we look here at the W-2. We have the employer's name, we have the employee Bumblebee, his date of birth, his TIN, his taxpayer identification number, or that could also be social security number, his occupation, address, phone, best contact.
Can I stop to ask a question?
Yeah, sure. Yeah, please.
So TIN and SSN are basically like interchangeable.
Correct.
Okay. So is the TIN literally just the social security number, but it's
Yes.
just rebranded? Okay. Okay.
Yeah, it's the same exact words because it's a taxpayer identification number. Some people have different, they have an ITIN if they're here on a work visa. So it's an identification number. For most of the time, it's a social security number.
Okay.
We have email, so yes, that's the same thing. For a business, it's an EIN. And when you look down
Okay.
here at the employers on the W-2, the employer's EIN, again, that's the tax identification number for businesses. So a business
Gotcha.
will have an EIN. So he made 50,000 in wages, 5,000 withheld, Social Security wages 50, Social Security withheld, Medicare wages and Medicare withheld. And he received a 1099 from Queen Bee Securities, and his interest income was $2,500. And again, they have an EIN number because they're a business. 1099 dividends from the bank, Hive Bank, in the amount of 800 of ordinary and 600 qualified. So when we do the 1040, um, so we're going to basically fill out his name, social security number. If you want to ask them, you do not have to answer this presidential election campaign. You get here to the filing status. So the big thing on any tax return, any tax form, any schedule is you want to do what's called read the line. So we just want to go through every one of these things and read. So we have to check one box only. So we have to figure out his filing status is, and we decided he was single, never married. And then digital assets. Again, you have to ask your client, did you have any digital assets? It's a virtual currency, Bitcoin, those kinds of things. Some people, and I had a client who produced Bitcoin. I'm not exactly sure how it works because it's over my technical level. But then we have to, that was a business. But this is for somebody who buys and sells Bitcoin. Uh, and if you had some, you have to, or if you didn't sell any, but you have a digital asset, you have to record that. Okay, so then we come down here to the deduction. Um, is he a dependent of someone else? Is your spouse as a dependent? Your spouse itemizes on a separate return, or you were a dual status alien. They use alien for a non resident US citizen. Age and blindness, there is, if you're over a certain age, you get an extra deduction for a standard deduction. So were you born before January 2nd, 1960? Every year that will change on this. And are you blind? If you're blind, you have another deduction. And then we go down because Mr. Bumblebee had none of these. So on line 1A, what number do you guys have?
I have 50K.
Right. Okay. So that's correct. So you're going to put 50,000. So his other income is interest and dividends. Where are you putting the interest income of 2,500?
I'd put that at 2B.
Okay. But let's go back to the lesson is when do you have to use a Schedule B? So if the interest is over 25 or over 1,500, you have to put it on a Schedule B.
Oh, right. Okay.
All right. So we want to always make sure that, what's our interest? And so this is our Schedule B. So if your interest is over $1,500, you have to fill out the form Schedule B. And then when you fill out that, we're also going to put in here our ordinary dividends. Okay, so we go back. His dividends were the total ordinary and qualified dividends were 600. So when we go back to our 1040, where are you putting? So here's 3A. So you're going, and again, read the line. Qualified dividends. We just saw what that was on your form. So a lot of this is they're giving you the information. You just have to take the information from the source document, the tax document, and put it on the form. Ordinary dividend, 800, qualified 600. Go back to your, so the qualified 600 will go in 3A and ordinary will go on 3B.
I got that. Yep.
Okay.
Do you mind explaining the I'm sorry. You had
Yeah,
just
sure.
mentioned the name of the form, and now I'm forgetting the other one where if you exceed 2,500,
Right.
then you. So is that something that you would attach to the 1040?
Correct.
Okay.
So your 1040 is like a book. So you first do your form numbers. It's 1040. Then if you have any forms, 21, 63, 2106, any form numbers, and then it's schedules.
Okay.
And it's A, B, C, D, E, F, so your schedules.
And then so in 2B, since it did exceed, would you jot in the 1040 2,500, then continue down the 1040, or would you pause, then fill out the Schedule B, and then return to the 1040?
Well, right. In theory, you would pause, fill out the Schedule B, and then that will flow back to the 1040.
Okay.
For most of the time in 2025, for the last 10 years, most
Yeah,
of this is done on computers. You have to learn it where the forms are and why how they flow so you can check your own computer.
I
Um,
see.
because the computer, you can enter the data in, and if you enter it wrong, the computer will carry it to the wrong form.
Right.
And you have to understand tax law, tax theory, and the fact that, over $1,500, the computer will automatically generate a Schedule B.
Okay.
But you want to remember that, for our purposes here, and going forward, because and it's the thing of qualified, and especially when we go back here to the qualified dividends versus ordinary dividends. Some of the source documents can get convoluted. So you
Okay.
have to kind of know what to look for. And once you fill a Schedule B out for interest, you have to fill it out for dividend. Once you fill it out for dividends, you have to fill it out for interest. Like,
So if you pass 1,500 just on the interest, then it's just a total domino effect.
correct.
Okay.
Right.
Interest. Man, that's great. Yeah. Huh. Okay.
Yeah.
All
So
right.
once you pull out a Schedule B, finish it.
Yeah. Okay.
Finish the
Yeah.
form. And,
Gotcha.
and also it's going on this Schedule B is interest and dividends.
Okay.
Um, so when you add up all our total income on line 9, and we're going to go through this of other things that you can have income from. We're going to start that tonight. But right now, those are our only three sources of income: is the W-2, the interest, and the dividends. So what do you have on line 9?
I had 53,300.
Okay. Okay, right. So you're not adding in any of this other qualified, you're not adding in any other, you're only adding in the ordinary dividends. So 53,300. You're going to look up the standard deduction, and we're dealing with 2024. So the standard deduction for a single person, 2024, under the age of 65, is 14,600. So that's going to be deducted. That's his standard deduction. If we're going to itemize, we need to know how much mortgage interest, and we didn't do itemized yet. We will get to that, but we're not doing itemized here. So we're just doing income. And then you're going to subtract that 14,600. Those are his total deductions. If he had a business, he might have we call this a QBI, qualified business income deduction. He doesn't have that, so we leave it blank. So his taxable income. So here is his adjusted gross income. These are important numbers as we go forward. It's 53,300. Taxable income is 38,700. And then you open up your tax table. So what number did you get here for tax on line 16?
Unfortunately, I didn't make it to 16.
Okay.
I made it to like 12, or yeah, I made it to 12 and then kind of took a pause and then went to payments and then
Okay.
like filled stuff in for 25 A and D, but I think that might be wrong to be honest, but
Right.
yeah.
Okay. So his tax here, so we're gonna go to our pub 17. So his okay, so Myras, we always round numbers. So if it's 51 cents, you round up. If it's 49 cents, you round down. Most documents will not have that. Fortunately, on the computer software that we use, it automatically does that. So if we put in 40, $3.46, it'll put in $3. Yeah, so we don't do cents in for tax returns. So his income was 38,700. So we're going to go to our Pub 17, and then we're going to look for the tax table. So that's on page 112. So we're going to go through this tax table and we're going to find 38,700. I'm going to load up a little bit. Is that, I don't know if that makes it easier. So 38,650 to 38,700. Now, if your software uses there's a tax rate they can use, or they can use a tax table. So at 38,700, his tax here as a single person would be $4,415. So here they use the tax multiplier. So when we do the software versus doing Pub 17, this is kind of the interesting thing, is you can get two different numbers. And that's the I can show you how to do the different ones and why did the software, because I did my homework on the software, get a lower number than what we got here, is because the software will pick the best tax liability for the client. But if you don't have the software, this is where you go to figure out your taxes.
Is the software like TurboTax-esque, or is it more
It's
tailored?
it's a commercial software. It's for tax, it's for accountants. So
Okay.
it's not, but it's similar to TurboTax. I mean, TurboTax just asks you a question. This is, you have to kind of know where to go with things.
Okay.
But it will, if you fill out all your source documents correctly, and then if there's anything else that you have to enter, like deductions or credits, the software will figure out what's the best tax liability. So that's always
Okay.
nice. I always like to show you though how to look it up. Uh,
Definitely.
yeah, so and that's what your Pub 17 you're going to use, and then you're going to use he's a single guy, um, $38,700. So, all right, so we go. So if you have whichever you have, if you're in that ballpark. So the federal tax withheld was 5,000 in box 2. We don't reconcile Social Security or Medicare tax unless the employer withheld incorrectly. This employer withheld correctly, so the Social Security tax, Medicare tax does not get reported on the federal 1040 return. So he has a refund of $657. And you're going to put your name when I become the third designated of all our tax uh, 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 clients, and then the paid preparer with your PTIN. By next week, everybody should have a PTIN if you're going to be a paid preparer. You have to get it before you have to renew it before the end of the year, or before, I think it might be December 15th. But so you put your PTIN in there. When I first started doing taxes, you had to put your social security number in. And there was a lot of controversy because I was giving my social security number out to 300 or 400 people every year. So now we can just use PTIN, which is your professional TIN, taxpayer identification number. So you're so 35A, I'm just reading w- so why was 35A? So that's the refund. So line 34 is the amount of overpayment. So the tax liability was $4,343. $5,000 was withheld in the federal tax. So, and that's the only thing that this is if you make estimated payments, you have some credits here. Um, they're all, but either a W-2, 1099, anything withheld, or you make in estimated payments, or you have some credits. So the whole payments was 5,000. I'm not sure how you got one. Was for line 35A. So yeah, so if you're rounding, all of these numbers that we were given were whole numbers, so there was no rounding needed. So I'm gonna give you more homework tonight to keep practicing this kind of stuff. It is really important that you get the flow of where things go on a return. Because when you complete a return, even though the computer did it, you got to be able to look at it and say, oh, I made a mistake here. Or this doesn't look right. Let me go back and check it. We're going to get, we're going to keep talking about income. Um, so tonight, though, we're going to talk about Social Security income and unemployment income. Okay, so unemployment, a 1099-G can record many kinds of different income the from different sources. So a 1099-G will have unemployment. If you get a refund from the state or local, that'll be in box two. Unemployment compensations box one. Unemployment comp is taxable. Certain states it's not taxable, and certain states it is. But we're only going to deal with federal for this year, for this course. But the unemployment comp will be in box one. And then if they withhold any federal income tax, they'll have that in box four. So again, it's certain government payments. So if you receive government payments, box seven's for agriculture. That's for farmers who receive some government payments, subsidized. So it's an 1099-G, again, IRS form that government agencies use. Some are taxable, some payments from government agencies are taxable, some are not. So we have to always look at it. But for we're learning a basic tax prep. Most of the time it's going to be people who have received unemployment. Okay, and unemployment is, to collect unemployment, you have to be actively searching for employment. And you're unable to find it. We have a lot of numbers that come out if you listen to any financial news about what's our unemployment rate. As unemployment rates increase, it means our economy is struggling. When unemployment's low, it means that, hey, we're doing pretty good in the economy. So the rate is calculated by the number of unemployed people by the number of total people in the labor force who are employed or unemployed. And when they do this, they only consider unemployment people who are of the working age or who are seeking employment. So they're not, including here, your 84-year-old grandfather is not considered in this unemployment rate because he's not working, and nor is he probably seeking work. So unemployment compensation. So our unemployment compensation is, just like I said, it's fully taxable. It's reported Form 1099-G. It's going to go now here, like our Schedule B, the unemployment income is going to be reported on a Schedule 1, line 7. And the federal withholding for box 4 goes back on where we put the federal withholding for the um on the W-2, we could put that same place. This is a 1099. So they on the 1040, we saw a line for the federal withholding from the W-2 and a federal withholding from 1099s. So if again, you can read more. We're again in uh, chapter 5 in our Pub 17. So we're just kind of moving through the Pub 17. Publication 17 on all of these items goes into further discussion. So here's a 1099-G. It's a fake one because it's for 2025 and they're not out yet. So, but you can see in box 1 is our unemployment compensation. So you can collect unemployment comp. You have to work so many weeks prior to being laid off. During COVID, a lot of people collected unemployment. People who didn't normally collect unemployment received unemployment compensation. So it is a taxable benefit. And it's for people to hold them over from a time of being employed to a time of not being employed. If you're self-employed, you cannot collect unemployment. So if your business goes belly up, can't collect unemployment. So you have to be an employee of somebody, and you get laid off, or you're seasonal if you're do groundskeeping and maybe you only work in the summer or 8 months of a year. The other 4 months you can collect unemployment. So your employer and you, with every paycheck, pay into unemployment, and that's where you receive the benefit of it. Box 2 is your state and local tax refunds. They're filling out all of these boxes on this as an example. And they're saying that box 2 was for the year 2023. So if you receive a state or local refund, it usually will tell you what year did that come from. Because sometimes you'll receive, a state refund from 3 years ago. So we have to say, when did that refund take place? And that comes into play if you can write off your taxes on a Schedule A. And, we'll go into that, but just to kind of keep this in the back of your head here is if you write off the taxes in this year for taxes you paid, if I write off my taxes, but then I get a refund, that becomes income. So that box 2 tells us what year it's from. And box 3, what year it's from, but box 2 is taxable if you filed a Schedule A in 2023. So if you took a standard deduction in 2023, that amount's not taxable. So we always have to ask people if they're a first-year client. If we've been doing their taxes for a while, we're going to know, or at least we have the copies of the returns. If you're preparing returns for clients for pay, you have to keep copies of their returns for 3 years. The IRS will allow you to keep them digitally, but before they used to make you keep them in files, paper, and I had basements full of filing cabinets because we had to keep everything for 3 years for every return we did. So I had kept returns for about 5 or 6 years or more. So when Carolyn started working for me, she was big on like, let's digitize everything. So we went from about 8 filing cabinets to now one drawer in a filing cabinet. So we have condensed. And being paperless is just so much easier. And just like doing this workshop, I have I can pull them up off my hard drive. Everything's there. So box 4 is your federal income tax withheld, and that you're going to put next to your W-2 because this is a 1099. So this will go online with the 1099. And taxable grants, if you receive a grant from a state or a federal agency, for the most part, they're going to be taxable. So a lot of times people think if you get money from a GoFundMe, if somebody does a GoFundMe, um, they are taxable. That GoFundMe money is taxable to the recipient. And if it's a GoFundMe, the person who gave money, be 99% of the time, the recipient is not a is not a charity, so you can't deduct your deduction to that person, your gift. So here is where on line 7, and this is your schedule 1 that will be attached to your 1040. I'm going to upload, if I can do this, some files for you. Uh, so that you can have these like the full files. So I'm going to put them in the chat. The schedule 1 we're going to use. If you have, and everything again, the 1040 is your book. And then you have different forms. If you have a small business, sole proprietor, you have to fill out a Schedule C. And you'll see on line 3, that'll go into there. Gains, if you have real estate, if you rent properties out, you have to put that will go on a Schedule E, and then the net income will go here on line 5. If you have a farm, there's actually one or two farms, there's some not-for-profit farms in Philadelphia, but there's only one or two for-profit farms. One is actually a flower farm in Philadelphia. That farm income would go here, but we don't see a lot of that in Philadelphia. So you have, if you won money in gambling, if you have cancellation of debt, if you have credit card debt and you get it canceled, it becomes taxable income. So this is all for additional income, and then part 2 of this Schedule 1 is adjustments to income, but we're dealing with income tonight, and unemployment compensation will go here on line 7. So here's another 1099-G for just state and local. So here's she overpaid her state. I guess I'm gonna assume it's a she. Overpaid her state. Now, when you ask about rounding numbers, we would put in our software $235 because we're going to round that up. So that refund, and then we have to ask the taxpayer if they itemized in 2014. And if they itemized, it's taxable. If they did not itemize, then it is not taxable. Down here further is where your state and local refunds will go. Okay, you guys got those files? I think so it's just a blank 1040, Schedule 1, and these 1099-Gs. Oh, here. Oh, there. Sorry, it's line 1 is the taxable So we were talking here about the taxable refunds from the state or local income taxes will go on line one. Unemployment will go on line seven. Those will be added together on Schedule 1, and then they go back on our 1040. And I'm going to show you on the 1040. And this is how all your tax returns are going. There's a flow tool. There's actually a method to this madness, but so on your 1040 under income, you're going to have line 8, additional income from Schedule 1. Okay. So line 8 will record the total amount of those two items together. And then you're going to, on your 1040, you're going to add all that together before you get the amount of your taxable. That's a part of your total income. We're going to do these two incomes, and then we're going to talk about Social Security income next, and then we're going to talk about some other case studies. I think it's good to have Meyer kind of asked for it last week, is to have situations where you can fill out these tax returns, and that's what you want to get practiced at. So, okay, so we're going to go here to Social Security income. So it's a benefit, and that's where your FICA and Medicare, that's your Social Security. Together, that makes Social Security. Medicare is the insurance that people on Social Security can receive. Now, it's a monthly payment by the US government is paying. It's reported on an SSA 1099. You're going to see a lot of 1099s, 1099 miscellaneous, 1099 NEC, 1099 INT for interest, 1099 dividends. So we're going to see this 1099Rs. So we're going to see all of these kinds of income sources that are reported on a 1099. It just depends what kind. So for Social Security, it's basically retirement benefits. So they've worked enough in their lifetime. So, and depending on your income during your lifetime, how much Social Security was withheld will determine how much Social Security you receive. So you have to be over the age of 62. You can start taking Social Security at the age of 62. But full retirement now, it used to be at 62, then it went to 65. And I believe, don't quote me on this, it's at 67 now. We're living longer. So they're saying full retirement. And at full retirement, there's a certain dollar amount you're going to get. You don't have to take it, but at some point, I think when you're 72, you have to take it. Or you lose it. I mean, that's the other part, is this is money you've paid in to your retirement. Hopefully you'll also have a retirement with your employer. You paid in retirement. If your employer doesn't have it, you pay it yourself. Somebody like myself who's been self-employed my whole life, I've had to contribute myself because Social Security doesn't give you a large amount. It's not enough to support you. You get right now, I think people who are getting Social Security, receiving Social Security, is anywhere from $800 a month up to about $3,000 a month. So you can get a large amount depending how much you earned during your lifetime and working. Now, when you take Social Security, you can also continue to work. and continue to have employment and have other sources of income. Now, SSDI is Social Security Disability Income. This is given to people who are disabled, and you can be of any age. And if you're disabled, your children also can receive Social Security. For the most part, very seldom is SSDI taxable or reportable. If a child gets SSDI, it's not reportable at all. You have to qualify. It's a lot of hoops to get SSDI. It takes you about a year or two to get through, which is unfortunately, if somebody's really disabled, they need it now. There's also survivor benefits that if someone passes away and they paid into Social Security, and this came about during the coal regions actually brought this law about because when the husband usually passed away from black lung disease, the spouses were left with no income because the husbands earned the money, the husbands paid into Social Security, and the wives did not, and the children did not. So they changed the law that if your spouse, your parent, paid into Social Security, and when they die, the children have to be a minor. So if you're an adult and your parent passes away, you do not get their Social Security. But if you're a child, a minor under 17, you can collect from your parents' Social Security. And it's called a survivor benefit. If you're a spouse and you're over the age of 62, you can you have an option to collect from your own Social Security or from your spouse's. And oftentimes, depending if your income was less than your spouse, you would collect from your spouse's Social Security. So that's why you want to always marry someone who makes more money so you can collect, you have a choice. That's just bad dating advice. Okay, so the Social Security it's supplementing security income. It is not meant to be full income. Um, uh, yeah, I'm sorry, SSI. So you can also SSI will help you if you're low income individuals, if you're elderly, blind, and disabled. But once you reach the age of 62, as long as you have paid into it, and that's where when we see this Social Security and Medicare on a W-2, or you have self-employment people who pay self-employment tax, that's their Social Security and Medicare. When they paid into it, you are eligible to collect. You have to work a certain amount of months. I've seen from the 50s and 60s, I call them leftover hippies, who did not work on the books, who worked always under the table, always for cash, never paid into Social Security. All of a sudden, and we're seeing it, they're the baby boomers. I'm at the end of the baby boomers. So the baby boomers are now all collecting Social Security, and it's a large number of people. But if you were someone who opposed taxation and didn't pay in, you do not get Social Security and you do not get Medicare, which Medicare is the insurance leg of Social Security. So if you haven't paid in, you're older, you don't get to the benefit of this. So oftentimes I've seen where and heard of individuals who, as they age, once they hit about 62, 63, they start filing tax returns. I'm not sure the exact amount, so don't quote me, but I think it's 3 years, 2 or 3 years that you have had to pay in to get the minimal benefit and to get Medicare, which is the insurance that seniors use. And you'll hear about that all the time. So not all of Social Security is taxable. It really is depend upon your combined uh, income. And it's your combined income from you and your spouse to determine how much of your Social Security income is taxable. I'm going to go through tonight all of these calculations. It's going to be confusing. Still confusing for me when I have to get out, but I have to get out the worksheets. I can't do it in my head. Some people I know can do it in their head. I'm not one of them. Um, so if your combined income is below 25,000, 32,000 married filing jointly, your Social Security is not taxable. So this is all your income that's not from Social Security. So if you have a little part-time job, you have some interest, you have some dividend money coming in, and maybe you have a retirement fund from somewhere else. All of those income combined are and you're single, under 25,000. All of your Social Security is tax free. So if your income's above those level, up to, 50 to 80%, 85% of your benefits could be taxable. So what has happened is Social Security used to not be taxable at all. But if you made a certain dollar amount, you couldn't collect, and people complained. I paid in all year, now I get no money. So it's now everybody who paid in can get money. So if you're still working at 70 and you're 70 years old, you're working in your corporation and you're making $300,000 a year, pretty much your Social Security benefits are taxable. But if you're lower income, you're in your 70s, you can't work, or you don't want to work at this point, and you have a small pension where you get another $1,000 a month. So you're getting 12,000 in a pension, you're getting 1,000 a month, you're getting 12,000 in Social Security. The $25,000 threshold is only for income that's not Social Security. So you could make 24,000 in a job or 24,000 in the market or have another IRA or retirement fund. And as long as you're making under 25,000, none of your Social Security is taxable. We're seeing a lot of people now are collecting Social Security, full Social Security in 67, and they're still working. There's a lot of people still in the workforce who are in their 70s and 80s. So this is what a Social Security statement looks like. This is an actual statement from one of my clients. I took their name off. I figured out how to doctor a PDF, but this is an actual amount that they got paid in benefits, and this is their forms SSA 1099 Social Security benefits statement. A lot of people think when they get Social Security, they don't have to report it. Even if it's not taxable, we still have to put it on the tax return. So people will say like, oh, well, yes, I received Social Security. You ask them the question. If they're all, I ask everybody over 62, did you receive Social Security? Yes, I received it. But, they'll say, no, it's not taxable. I still need to see the statement. And then they'll have to come back with this Social Security statement or call Social Security. But now you can go online and get the statement. So we have what's called base amounts. If you're single, 25,000, and this gets adjusted every year for inflation. Single head household or a qualifying surviving spouse. Married filing separate and lived apart from your spouse. This is really important. If you lived apart from your spouse but you're still married, and lots of times clients are separated, and I've had clients that live in two different states for whatever reason, your deduction, your base amount is 25,000. But if you're married filing separate and you lived with your spouse, it's zero. It's all taxable. So remember, we said this whole married filing separate is your worst tax bracket to be in. Married filing jointly, it's $32,000. So here's the part of our worksheet. So first we're going to see if any of it's taxable. So, and again, if you're filing a joint return, you have to include your spouse's income in here when we figure this out. So you're going to go through all of your 1099 SSAs, box 5. Or if you retire from the railroad, you would not get an SSA 1099, you would get an RRB for the railroad 1099. Sometimes if I have had a client who fought to get Social Security, there was some screw up, and then all of a sudden, 3 years later, they got a lump sum. We're going to enter all box 5 here. So if it's 0 or less, you don't need to file this, but hopefully you don't pull this out with unless somebody has Social Security. So you're going to take line A and multiply that by 50%. So half of line A. Then we're going to do the total taxable amount, excluding line A. So all the other taxable income, total income. So that's your pensions, your wages, dividends, capital gain, all of that income we're going to enter on line C. We're also going to add in here tax exempt income. So when someone had tax exempt interest, like we talked about last week, that would be on line D. So when we add lines B, C, and D, that's what we're going to consider as our total income. That's half of Social Security income, all of our other income, and all our tax-free income. So then we go back to our line E is our base amount. And then we're going to go back to our filing status. If they're single, if they're filing jointly, single is 25,000. Filing jointly was 32,000. So we're going to go back here to those baselines. So if line E is more than 25,000, if it's single person, or 32,000 married filing jointly, if it's more than that, then they have to claim some of their Social Security income. So here's an example: is you're single, you file Form 1040 for 2024. So you receive a fully taxable pension, retirement money. You have a part-time job, and you have taxable interest income, $990. So the total income is $28,990. You receive Social Security benefits in 2024 shows $5,980. And you receive a form in January 2025. So in January, everybody gets their forms, and that's when we're going to get a lot of calls and questions in January. So here's the form and this goes on to now figuring the tax on it. So box 5 of their 1099 SSA was 5,980. Half of that is 2,990. So we're going to combine those other income sources, 990, 94, 18,6. That gives us 28,990. Right. So when we combine half of Social Security, all the other income together, we get $31,980. If you guys need me to stop, just say stop or shoot a text here in the chat. So is the amount on line 7 less than the amount on line 6? And again, all of this worksheet is read the line and just, is the amount on line 7 less than 6? Yes. Okay. So there's no other income. Okay. Um, but that doesn't make sense. But sorry. So if you're married filing jointly, it's 32,000. What did we say this guy single, right? Single person, single head of household, 25,000. So we take 25,000 from the 31,980. So he has some taxable income. Okay, so you're going to subtract that 25 from the 31 and we get $6,980. Then if you're filing jointly, this is where this Social Security worksheet can get really convoluted. If you're married filing jointly, or 9,000 if you're single, head of household, you subtract. So this guy is single, the 9,000. So we're going to multiply this 6,980 is the lower of those two numbers. And that is the amount. We're going to multiply that by 50%, and that's the amount that becomes taxable. It's a very convoluted worksheet. It's on page 65, this exact sample, page 65, pub 17. You should study this. This may be on the final. So you're going to enter this smaller line 2 on line 14, which is 29,990. So the taxable benefit under the smaller 1040 line 6B. So here on our 1040, you can see line 6A is the total amount of Social Security. Line 6B is our taxable amount. So we have to go over to that worksheet, do the worksheet, and then come back to the 1040 and enter in what part is taxable. Is that clear as mud?
Not quite. Do you mind explaining it one more time?
Sure.
I'm sorry.
Yeah, so let's go. Okay, so here's pub 17, and this is page 63. What what this is the worksheet to see if you even have to figure out if it's taxable or not. So that's the first worksheet you're going to do. Then when we go over, so this is our example that I just went over, is you're single, single person, and you file Form 1040 for 2024, and you receive the following income in 2024. So I'm on page 64 at the bottom right. So when we go down here is same example, fully taxable pension was 18,600. Wages from the part-time job, 9,400, and taxable interest income, 9,990. Total income, 28,990. Okay, so this person received $5,980, box 5 of the 109 SSA 1099. So they receive Social Security in the amount of $5,980.
Okay.
So here's our, figuring it out. And this is it. The worksheet I went over in the spread and the slides, but it's the exact same worksheet. I just broke it up. And this is what you would do if this is your case, and somebody comes to you and says, "Hey, I received $5,000 in Social Security benefits. Is it taxable?" Well, you have to ask, "What's your other income?" Because it's really based on your other income, not on what you receive Social Security. Half of your Social Security is figured into income, but so here we have 50%. So we have the Social Security amount. 50% of that is considered in our income for Social Security taxability. So 2,990 is half of the 5,980.
Okay.
So all the other income that we saw up here, from pension, wages, and interest income, came to 28,990. We're going to put that on the worksheet on line 3. So there's no 2A on the 1040. 2A is not, no income from tax exempt, no foreign income, housing allowances. So the total income is the 28,990 plus half of Social Security, 31,980. Single person, that's over $25,000. So yes, so we subtract it because there's no other income here. So we subtract that, the 25,000 from the 31. $980, which then we go up, and all this worksheet it's convoluted, but if you take your time and you read the line.
When you're saying the line, you're referring to those totals that are underlined.
I read the line is, yes, subtract line 7 from 6. Okay.
Okay.
Yep. Okay. If you are married filing jointly, no, not married filing jointly, single. Okay, we're single. Okay, it's 25,000.
Okay.
Yeah, that's what I mean by read the line. Like on the tax forms, like all the forms will, sometimes people get confused by them, but try not to overcomplicate it. Yeah, I'm gonna
Okay.
say, yeah, taxes can be really simple if you don't overcomplicate it. But a lot of times we want to figure more out.
Okay. So do what it's telling you and not think about it too much. Like,
Correct.
okay.
Yeah, because sometimes if you try to, like, well, why is this qualified dividends and this is ordinary? You don't need to figure that out. That is, if you want to figure that out, take an investment class. But for tax purposes, you don't need to know.
Okay.
I mean, I like knowing, but it's years of doing it, and every year I learn something new. I still learn new things. I just, like, okay, let me research this or let me figure this out. Why are we taking, what's the modified adjusted gross income versus the adjusted gross income? And those are things that you can just continue. This is a field you can continue learning.
Mm-hmm.
But for when you're doing tax returns, just read the line. So, if you're married, so here, note, if you're married, filing separate, lived with your spouse at any time, skip lines 9 through 16. Well, this guy was single, so we can't skip those. So here it is. So line 9 from line 8. So we take the 25,000 from the 31,980. which is 6,980. And then it just say, enter this number. If you're married, filing jointly, enter 12,000. If you're single, enter 9,000. This is a single person, so we enter 9,000. And then enter the smaller of 10 or 11. What's smaller? 6,980. Multiply line 13 by 50%. So the 6,980 is the part of the Social Security that tentatively could be taxable. But then we're going to multiply it by 50%, and you're going to enter the smaller of line 2 or 14. So now you got to go back to line 2, which is 29,990, half of your Social Security. So we bring that over. So if your income was closer to the 25,000, that may be different. But for the most part, this is going to be the formula, that it'll be half of your Social Security will be here on line 15. So you add line 15 and 16. 16 says multiply line 12, which is 0, by 85%, which is 0. So it's 2,990, and then we multiply line 1. So we're going to go back to line 1, $5,980 by 85%, which is 5,083. So 85% of our Social Security receipts could be taxable, but they're going to ask us for the smaller of line 19, smaller of 18 or 15, smaller of 18 or 17, and it's the 2,990. It's half of our Social Security is taxable. So the amount on line 19 is our taxable amount. And then that's going to go on line 6B of your 1040. I think following it in a book is easier for me. But you can, I don't know if it's easier for you. We can go through another example. I mean, the book has this Pub 17 of every idea and every tax situation, they're going to give you an example. So it's really good to read this as we're going through. So Casey and Pat Hopkins file a joint return for Form 1040 for 2024. Casey's retired and received fully taxable pension of $15,500. Casey also received Social Security benefits. And Casey's Form SSA 1099 for 2024 shows net benefits, box 5, $5,600. Pat worked during the year and had wages of $14,000. Pat made a deductible payment to Pat's IRA in the amount of $1,000 and isn't covered by a retirement plan at work. Casey and Pat have two savings accounts with a total of $250 in taxable interest income. They complete worksheet 1 worksheet 1 is over here. So again, 29,750 is the 15,000 is a pension and the W-2 income and the taxable savings interest, bank interest. They find none of Casey's Social Security benefits are taxable for 1040 and enter 5,600 on line 6A and 0 on 6B. Okay, so we go over here. And here's it's broken down. How much is it? 5,600 Social Security benefits, we divide that in half, 2,800. So we combined all the other incomes, came to 29,750. When we combined the pension, 14,000 W-2 income and 250 taxable interest, 29,750. And they're married filing jointly. Their threshold's 32,000. But we can go through this whole, worksheet. So when we combine, and you want to do that, you want to combine all of their income, the 5,600, the 2,800, the 29,750. Together on line 6, you're going to get 32,550. So on line 1, they have on schedule 1 was $1,000, and that was from would they receive $1,000? Oh, they received $1,000 from Pat's IRA deduction. So schedule 1, the first part of schedule 1 we saw was income. The second part is deductions. So we can deduct the $1,000 that they put into an IRA as a deduction. So the net income here is 31,550. Married filing jointly. So they do not have to, we can stop. None of their Social Security is taxable. So if you've considered, but there's some more worksheets in your book. This one's about railroad is exactly the same as Social Security. Retired railroad, and we get some of retired railroad workers because of SEPTA. SEPTA is considered a rail, if they worked on the train lines. Amtrak workers, all of those are retired, are railroad workers. Okay, so I have some homework for you. So I'm going to upload a problem for you to complete this week. And we'll go over it on Thursday. So let me go to the chat area, and I'm going to put the homework there for you. Just takes a minute for the files to upload. So I'm giving you 2 source documents, 2 tax documents. And this is similar to what homework you had. So try to finish this as best you can. So you have a W-2 and an interest statement. I just want you to get used to filling out the 1040 and where things go and what things are counted, what things aren't. Because I don't think either of you got them perfectly right. So, and it's good, if you get 90% of it right for our purposes to pass, but for taxpayers, when you're preparing a return, you have to get it right. They don't like when the IRS gives them letters. They're going to call and yell at you. And even if it's not your fault, I've had clients not give me W-2s or not give me their interest statements, and it's not my fault. It's still my fault. Well, don't you? They think for some reason we have this extra power to get these documents somewhere. And legally, we cannot get a taxpayer's documents unless they sign off. And then you have to pull each person's transcript. And we don't do that for every taxpayer. It's costly, one, and timely. So they have to provide us with documents.
That makes sense. Yeah.
Yeah. But it's always going to be, oh, it's your fault, you forgot. All of the returns that we do in our office, we have audit protection for this main reason. I used to not. So I pay for protection. Some accountants will let people opt out or opt in and they charge a fee for it. I make everybody get it because this way, if there is an issue, they can go to these people and they handle the audit. I do handle some of it or I'll help them. Um, but audits can be time consuming and taxpayers do not want to pay you because they feel like, oh, I paid you to prepare my return. And there's a 20%. I don't know what's going to happen this year with our the new IRS and the cutbacks in the IRS, but historically, 20% of all self-employed people had a chance of being audited. Uh,
Wow.
yeah, and that was before computers, and now everything's locked up. If someone issues you a 1099, you have to claim it. They know. Um,
Hmm.
so when you're self-employed, you have a higher chance of getting audited. And it's really easy to audit somebody who makes $50,000 than someone who makes 500,000. The person who makes 500,000 is going to hire me to represent them. If the IRS comes back and says to the person who makes 500,000, you owe us 10 grand, they're going to hire me and maybe we can get them out of some of it. The person who makes 50,000 and the IRS and comes back and says, "Hey, you owe $1,000." They're going to pay it because it's going to cost my fee is going to be more than 1,000 to represent them. So that's kind of one of the things the IRS will do. Like it's easier they don't have to spend as many man hours. Um, Biden, before he left office, put in place, which now has been taken out of place, but Biden put in place agents that just went out after high income earners, which has never happened in the IRS, where they go after just high income. High income earners are the harder ones to get taxes from if they're fraudulent because they have the money to hire attorneys and accountants to represent them. So, okay, so you guys, questions? Myron?
I have one actually.
Yeah, sure.
It was about unemployment. So like
Yeah.
my understanding of that is as you work, what's taken out of your check funds that, and any American that works, it's taken out of their check and funds that, and then that itself like is a tax. Um, so when you're saying that the IRS then like taxes a person that's receiving unemployment, is that kind of like a double dip, like a tax on the tax? I don't like I understand it, but I
Yeah.
don't at the same
Yeah.
time.
So the employer pays the large portion of unemployment.
Okay.
It's relatively new that where the employee pays some into it. It's not,
Interesting.
it's actually unemployment insurance is what it's called. It's kind
Huh.
of an insurance that, hey, and so Social Security and Medicare, an insurance that the government controls. Uh,
Right.
so unemployment is by the state. It's by the state you work in. So if you worked in New Jersey,
Hmm.
you may have to go to New Jersey and you live in Pennsylvania to collect unemployment. You would collect from the state you worked in. But yeah, it is. Some people feel it is a double tax, but for the most part, your employer is paying a much larger portion than the employee. The employee's is pennies compared to what the employer, and it depends on
Gotcha.
the
Yeah.
employer's rate um, goes up. So if you're like have a big landscaping company and every October you lay everybody off, your rate goes up. You have to pay more in.
Ah, okay.
Then
Yeah, see,
Walt,
I didn't know it fell into the employer's hands that much. That's interesting. I kind of thought they were more in the back seat, and then
no,
it was like your hourly workers that were getting a huge chunk taken. But okay, yeah,
yeah, and
that's
it's like if you're working year round at Walmart,
right.
your rate, the Walmart's rate is going to be less. But it's like, people who work in tax offices, they often, in April, May will go, their hours get cut, they go collect unemployment.
Right, right.
Then the employer's rates go up. And every time there's a claim, your rate goes up. So every time if I lay somebody off or my landscaper, I do big landscaping contracts, every fall when I lay everybody off, my rates are going to keep going up. Um, so that's why a lot of your landscaping companies do snow removal so they can keep their people working. They're making money
Oh,
year
wow.
round. Yeah,
Wow, I had no idea that was like a tax incentive. That's really cool.
yeah,
Wow. Yeah, super cool.
yeah. So
Thank
that's
you.
it. But the other thing that, and we're going to talk here and there about, but is some of the new tax laws, like people who are in food service and in the service industry who receive tips now get
Mm-hmm.
$10,000 of tax-free money.
Okay.
So their taxes, I mean, most servers want their tip in cash, but
Sure.
we always have to claim everything, whether it's in cash or traceable.
Mm-hmm.
So I always tell people, like, if you don't want me to know about it, don't tell me. Because when I sign that return, at the end of the day, I'm saying this is true.
Yeah.
So if I have a client that comes in here and tells me, hey, I made $20,000, I did a contractor, I made 20,000 in cash. I didn't put it in the bank. I just went to the market and I bought things. It's not traceable, but you just told me, so I am liable to report it.
Okay.
And what the IRS has done is they will come down and, like, if I get audited, if they find out that, hey, you're doing some really sloppy returns, they
Mm-hmm.
will audit all my clients.
Wow.
And they
Wow.
come in and they'll walk in and just the IRS will walk into an accountant's office and ask to see, okay, we want to see all your electronic filing signatures.
Oh,
And they have shut down and they're doing more of that because it's easier to audit the accountant and find out the accountant's screwing up. Um, there's a woman in
right.
Northeast Philly that you walk in her office and she say, well, how much refund do you want? And then she'd work your return backwards. Like,
Interesting. Yeah,
yeah,
this almost reminds me of when I used to resell things on eBay.
yeah,
Like commodity, sneaker commodity type things. And like if anything went wrong, a lot of times the seller would take the largest hit where the buyer would kind of be scot free no matter what. And this is
right.
almost, yeah, similar concept.
Yeah.
But
But
yeah,
you want to be honest. I mean, I had the IRS many years ago when electronic filing just started, when it was like the second year of e-filing. They
yeah,
they knocked on my door and they wanted to see all of my because you have before you can electronically file a return, you have to have the client give you permission by with a signature.
right.
And they wanted to see them all, and I pulled them all out. I had one unsigned return, so I had like a 97% they rate. They've never come back, you know. So, knock wood.
Yeah,
But
yeah,
but if you do good work, and most of the returns, I don't sign a return that looks bad.
yeah.
Like I have my one, I have two bad Google reviews for that because the one guy just wouldn't leave my office. I did his returns for a couple of years. I was just like, look, this is not realistic.
Yeah.
And I had one client I had to fire because I saw him doing stuff on Facebook that he wasn't claiming. I was like,
Mm,
I can't do this. And two
yeah.
clients actually I had one fired one last year who was a friend of mine and her husband. Oh, her husband was supposedly never worked.
Okay.
And then all of a sudden on Facebook, he's posting about his landscaping business. That's all cash. It's like
Oof.
I can't sign a
Yeah.
return knowing now.
Yeah.
Yeah.
You know what it looks like? Myra has a question in the
Yep.
chat.
Yep. Okay. Um, okay. Someone is paid by check and then withdraws it in check cash at the bank. Yes, the money's because a check is always traceable. And you also have to think is if I pay someone by check and they go and cash a check and don't claim that income, but I get audited and it's called what's called a reverse audit. So I get audited. I wrote the check. So I have a copy. Hey, no, I'm writing off this expense. I paid this person this amount of money. They will then go and check that person's return to make sure that they have claimed that money. So yeah, so a lot of contractors do that a lot. They think like, hey, just they'll take the check to the person's bank, cash the check, and then think it's not taxable. Well, no, it's taxable, and the person who wrote the check has a paper trail.
So does the bank too, probably.
Right, and the bank
So
has a paper trail. So you have a paper trail, there. So yeah. So which exercise do you want to practice, Myra? The Social Security again, or do you want to do the one I gave you for homework? The Social Security is going to be complicated. And I want you to have an understanding that when someone comes in and says their Social Security is not taxable, you understand that, well, it could be. That you have to figure it out or you have to let your computer figure it out. We went through these exercises for Social Security so that you know that it's a complicated formula. In practice, you're going to have a computer that does it for you. So in practice, you're not going to have to know that formula. You're going to have to know what to enter into the computer, and you have to know that if somebody says, "Hey, I made $50,000 working, and I got 10,000 in Social Security," I'm not telling you I don't need to report to Social Security. Yes, you do, because some of that's going to be taxable. But I'm not going to make you on the exam do a Social Security. I want you to understand it, like the concept that it's there. Going line by line is going to be impractical. But I want, and why I gave you the homework. Am I keeping up or talking too fast, Myra? So the homework, correct. You don't have to have all the answers, but you have to know where to go to find them. So when we do the final exam, for our purposes, I'm not going to give you a Social Security question for the final. But I want you to know where it goes and what it looks like, and that when you have someone come in who, says the word Social Security, they're on disability or they're over 62, you want to ask them, hey, do you get Social Security? You have to report it. And I can't tell you the number of people who have come in and for some reason they think Social Security is not taxable. And it's again like Jesse's example of unemployment, because Social Security you're paying in. But if you look at a W-2, your employer pays 7.5% Social Security and Medicare, and the employee pays 7.5%. So
what
Medicare
did you say the employer pays again? You said
7.5%, and the employee, it's a total of 15%,
okay.
and it's split. So for every dollar you earn and you
Hmm.
pay you have withheld for Medicare and Social Security, your employer has to pay that in as well.
Okay.
So you hear oftentimes like if you're paying somebody $10 an hour, it technically costs the employer $13 to $15 an hour.
I see. Okay.
Yeah, so a lot of those people, complain like, "Oh, I'm only getting $25 an hour," but your employer, it's costing 32, $33 an hour. So it costs a lot more because they have to pay your Social Security, Medicare, unemployment, workman's comp. So there's a lot of cost. Usually it's 30 to 40% for every dollar you get paid. It costs your employer to have you. That's considering you don't have any kind of health benefits or anything like that.
Gotcha.
That's just taxes. So yeah, so these are right. And when you have the computer, and we're gonna tomorrow night, did you guys both get the email about tomorrow night?
Are we meeting tomorrow instead of Thursday?
No, we're tomorrow night is just the bottom line meeting if you want to do tax prep. If you want, I sent an
Oh yeah,
email.
yeah, yeah. I know that. Yeah, I saw that briefly before class, but I got to read through all the way. Yeah,
Yeah,
I
so
got it.
that's tomorrow night and it's in the office.
Okay,
And we're gonna start training on the tax software. I mean, we're
okay,
tentatively that, so that's gonna be every Wednesday night for 2 hours. It's some of the stuff's gonna be way over your head and things that you haven't learned, but it's gonna be learning the software. It's gonna be all about the software, how
okay.
to do data entry, what it means. But I'd like for you to do the exercise I gave you that I just my last two documents, the W-2 and a interest statement, just so you get used to filling out a 1040, everything that you need to have in there. And
Sounds
that's why we go through every line. Did they have, did they have any virtual assets?
yeah.
All right. Other questions, Myra? Jesse, any questions?
No, none right now. Thank you.
Okay. All right, great. We'll continue with income next week. That's our last, then we'll go into some deductions. But
Sounds like a plan.
I'm gonna upload for you both of you our kind of our schedule for this class, like what we're gonna discuss each week.
Cool.
Um, Hold on a second. I can't, I don't know where I thought I had it up for you.
Take your time. You're good. That's computers for you.
I know. Anyway, where did I put that?
Mm-hmm.
So, there it is. I know I adjusted it. So I adjusted our syllabus that I just uploaded. Um, so it kind of gives you your dates and stuff. And then on the 23rd of this month, you'll have a take home um, exam that you'll have till Friday. I'll give it to you Tuesday. You'll have till Friday to finish it. We'll meet again on the following Tuesday, a week later, and go over it. So that's basically what you can expect. And then if you are interested in working, we're going to go over that tomorrow night of, what are the benefits, how you get paid, and then how to enter stuff. So it's an in-person meeting tomorrow night, 6 p.m.
Sounds good. And then another question, Wally. What remind me of what we need to register for? Or I don't even know if it's totally necessary. You would be able to tell me that, but yeah, you said that the deadline is the 15th or something.
Right. You need to get a P10.
Okay.
So we will we went over that, like the first class was the irs.gov,
Mm-hmm.
and then I'm gonna put it in the chat. So it's the irs.gov and it's called a P10. So
Okay.
you'll have to register as you want to go in, it'll say tax professionals. And you're an unregistered tax professional, but you can get a P10 if you want to get paid to prepare returns, whether you prepare them in my office or you just do it on your own. Um, you need that P10.
Okay.
They there's certain things the IRS, if you don't, the P10s, there's certain things, if you do bad tax returns, they'll shut you down. The IRS has a newsletter comes out every month, and they report what accountants they've shut down, or disciplinary actions they've taken. The other thing is payroll taxes never, you can get out of paying your own income tax for probably about 10 years if you do the right things, to push the IRS off. But if you have employees and you withhold those income tax, like we talked about, the federal tax, FICA, Medicare, because that's not yours, that's the government's. You're an agent. Once you become an employer, you're an agent for the government. You are working for free, collecting income for the government because you're
Mhm.
collecting employee taxes. And then you got to transfer them to the government. And there was a famous restaurant in Germantown who got shut down because one year she just did, she was running short of funds and used her employee taxes, and the IRS was not happy because if somebody's coming on unemployment, you didn't pay your taxes in, or if someone files their tax return and they're getting a refund, but your employer didn't pay in the taxes, now the government is out of money.
Mhm.
So that's when they came in and shut her business down.
Wow.
Yeah, one day just they
Just yeah, 1 year was all it took. Yeah, that's
yeah.
crazy. Yeah, it makes sense though.
Right, because you're stealing from multiple people, and
Yeah,
it was a restaurant. Nobody's making a ton of money, and they're all getting their refunds. But she didn't never paid the money into the government. She withheld
yeah,
it.
yeah.
So yeah. So, all right. So I'll see you, Myra, tomorrow. Six. We're going to be here 6 to 8 roughly.
Sounds
And
good.
then Jesse, if you're going to come, be good to
Yep,
see you as well. All right.
yep, yep. Thank you, Ollie.
All right. Thanks, guys. Have a good
Yep.
night.
Have a
Talk to
great
you.
night.
See you tomorrow. Bye now.
Bye bye.